Hey everyone, and welcome to today's Explainer. We're going to dive right in and totally demystify investing, showing you exactly how to build long-term wealth without that paralyzing anxiety of trying to perfectly time the market. If you've ever felt overwhelmed by the daily stock market headlines, you are definitely in the right place.
Here's our roadmap for today. We'll hit the market timing trap, dollar cost averaging explained, the math behind the magic, why investors love DCA, the lump sum alternative, and finally, is DCA right for you? Let's get going.
All right, part one, the market timing trap. Let's look at the classic hurdle almost every new investor trips over at some point.
So, be honest. Have you ever sat there waiting for the absolute perfect time to invest? It's incredibly common. You sit on a pile of cash because you're terrified the market's going to crash tomorrow. Or, on the flip side, you see the market hitting new all-time highs and you just freeze up, convinced you completely missed the boat.
But here is a massive reality check for you. Even the seasoned professionals on Wall Street struggle to consistently predict where the market will go next. Guessing the market is a losing game. Nobody has a crystal ball. And that is exactly why millions of everyday people and savvy investors alike use a completely different approach.
Which brings us to Section 2, Dollar Cost Averaging Explained. So, what actually is this incredibly popular alternative to market timing? Well, it's called dollar cost averaging, or DCA for short. It's a strategy where you invest a fixed amount of money at regular intervals, totally regardless of whether the market is up or down. It's beautifully simple. You commit to a schedule, and you just completely ignore the financial headlines. Market's up, you buy. Market's down, you still buy. Let's put this into perspective. Say you want to invest $6,000. Instead of dropping that entire scary chunk of cash on a single unpredictable Tuesday and just crossing your fingers that you picked a good day, you break it down. You invest at boring, yet highly effective $500 a month, every single month for a year. When prices are high, your fixed $500 simply buys fewer shares. But when prices are low, it buys a whole lot more. And that brings us to Section 3, the math behind the magic. Let's actually look at the data to see how this lowers your average purchase price and literally makes market drops work in your favor. Okay, imagine you're putting your $500 into an index fund over a wild roller coaster 3-month period. In month 1, the share price is sitting at a nice, clean $100. But in month 2, yikes, disaster strikes. The price drops drastically, all the way down to $50 a share. Then, month 3 rolls around, and it shoots right back up past where it started, peaking at $125 a share. Normally, this kind of wild volatility would have an investor sweating bullets. But what does dollar cost averaging actually do for you during that roller coaster? Well, in month 1, your fixed $500 bought exactly 5 shares at $100 a pop. In month 2, when the market tanked to $50, you didn't panic. You kept your fixed $500 investment going, and it automatically bought you a whopping 10 shares. Then in month 3, when prices surged to $125, your $500 naturally bought fewer shares, just 4. You're automatically buying more when it's cheap and less when it's expensive, without even having to think about it.
So, let's tally it up. At the end of this highly volatile 3-month stretch, you've steadily invested a total of $1,500. That's $500 times 3 months. And thanks to that terrifying market dip in month 2, your fixed monthly cash actually managed to scoop up a total of 19 shares, 5 plus 10 plus 4. Now here is the absolute magic number. If you divide your $1,500 invested by your 19 shares, your average cost per share is just $79. Seriously, think about that. The price started at 100, dropped to 50, and ended way up at 125. But your personal average cost is sitting safely down at $79. That is significantly lower than that $125 peak and even lower than where you started. So the big aha moment here is this. Market declines actually allow you to buy more shares for the exact same amount of money. Without DCA, most folks panic during a drop and just stop investing altogether. But the math proves that a market decline is actually a massive mathematical advantage for steady, consistent investors. Moving on to Section 4, why investors love DCA. Because beyond the brilliant math we just looked at, there is a deep psychological benefit to this strategy. Investors absolutely love this approach because it takes emotion completely out of the equation. Fear and greed cause almost all of our investing mistakes, right? But DCA keeps you strictly on schedule instead of reacting to scary news headlines. It builds ironclad discipline, basically turning investing into an automatic monthly utility bill. It completely eliminates the stress of timing the market, making it incredibly beginner-friendly. Whether you're using an IRA, a 401k, or a normal brokerage, you literally just set it, forget it, and go live your life.
All right, Section 5, the lump sum alternative. To be completely fair and objective in this explainer, we do have to look at the alternative. Are there any actual downsides to dollar cost averaging?
Well, yes, there is a catch. If you already have a massive pile of cash sitting there, say from an inheritance or a home sale, history actually shows that investing it all immediately as a lump sum often yields slightly better long-term returns. Why? Because over long periods, markets generally tend to rise. But listen, that is purely mathematical. Human beings aren't spreadsheets. Dollar cost averaging easily wins out if investing a huge lump sum all at once would cause you emotional panic during a sudden dip. Comfort and actually staying invested is often far more valuable than a tiny percentage of theoretical optimization.
Which brings us to our final section, number 6, is DCA right for you? Let's figure out if this is the strategy you should actually implement today. Dollar cost averaging is likely a perfect fit for you if you're new to investing, you rely on a steady, regular paycheck, or you're already investing monthly into your retirement accounts. It's also fantastic if you get nervous watching market volatility and daily stock charts, or if you just want a completely automatic investing plan. If any of those describe you, this strategy is practically tailor-made for your financial journey. The ultimate takeaway from our explainer today is this. Dollar cost averaging does not guarantee profits, and it certainly cannot eliminate market risk entirely. But it builds wealth one steady, boring investment at a time. The absolute best investment plan isn't the most mathematically complex one, it is always the one you can stick with consistently through both the highs and the lows. So that leaves us with one final thought. Successful investing isn't about finding the perfect day to invest. Will you stay paralyzed on the sidelines waiting for a perfect moment that might never arrive? Or will you let the math work for you, automate your habits, and start building your long-term wealth today?